FINRA Rule 4110, capital compliance. When necessary for the protection of investors or in the public interest, FINRA may, at any time or from time to time, with respect to a particular carrying or clearing member, or all carrying or clearing members, pursuant to authority exercised by FINRA's executive vice president charged with oversight for financial responsibility, or his or her written officer delegate, prescribe greater net capital or net worth requirements than those otherwise applicable, including more stringent treatment of items in computing net capital or net worth, or require such member to restore or increase its net capital or net worth. In any such instant, FINRA shall issue a notice by facsimile, overnight courier, or personal delivery. So it's this idea that FINRA can always say that the requirements must be higher than those that we've discussed, should they believe it's in the customer's best interest to do so for all firms or for specific firms, carrying or clearing member firms. Unless otherwise permitted by FINRA, a member shall suspend all business operations during any period in which it is not in compliance with the minimum net capital requirements that we have previously discussed. FINRA may issue a notice via facsimile, overnight courier, or personal delivery directing a member that it is not in compliance with applicable net capital requirements and that it must suspend all or a portion of its business. No equity capital of a member may be withdrawn for a period of 1 year from the date such equity capital is contributed, unless otherwise permitted by FINRA in writing. This does not, however, preclude a member from withdrawing profits earned. A carrying or clearing member shall not, without the prior written approval of FINRA, withdraw capital, pay a dividend, or effect a similar distribution that would reduce such member's equity, or make any unsecured advance or loan to a stockholder, partner, sole proprietor, employee, or affiliate, where such withdrawals, payments, reductions, advances, or loans in the aggregate in any 35 rolling calendar day period on a net basis exceeds 10% of its excess net capital. So you can't start draining assets out of the firm any more quickly than that. NASD Rule 3140, approval of change in exempt status. A member firm operating pursuant to any exemptive provision of this rule shall not change its method of doing business in a matter which will change its status to a fully computing firm that is subject to all of the provisions of this rule, the net capital rule, the aggregate indebtedness rule, without first having obtained FINRA's prior written approval. So firms can't just go from being an introducing firm to a clearing member firm without first having obtained FINRA's written prior approval. That's important. In making the determination as to whether to approve or deny such a change in a firm's method of net capital computation, FINRA will consider the type of business the firm is engaged in, the training, experience, and qualifications of persons associated with the firm's procedures for safeguarding customers' funds and securities, and the firm's overall financial and operational conditions. Anti-money laundering regulations, the Bank Secrecy Act. Money laundering involves disguising financial assets so that they can be used without detecting the illegal activity that produced them. Through money laundering, proceeds from illegal activities may be transformed into funds that appear to be legal. The Uniting and Strengthening America by providing appropriate tools required to intercept and obstruct terrorism. We commonly call this the USA Patriot Act. Amends the Bank Secrecy Act So the USA Patriot Act passed after 9/11, so passed in 2001. It was passed to increase the ability to prevent, detect, and prosecute international money laundering and the financing of terrorism. Amends the Bank Secrecy Act. So the Bank Secrecy Act requires every financial institution to file what's called a currency transaction report. So the USA Patriot Act amends the Bank Secrecy Act, requires all financial institutions, so broker-dealers fall under this, of course, to file a currency transaction report, we call them a CTR, with what's called FinCEN, which is the Financial Crimes Enforcement Network, which is part of the Treasury. Just like the IRS is part of the Treasury Department. So currency transaction reports are required to be filed by all financial institutions for each cash transaction that exceeds $10,000. This is a daily aggregate amount. I would definitely know that. This requirement also applies to the transfer of funds electronically, the purchases of certificates of deposit, stocks, bonds, and other investments. Currency transaction reports must be filed with FinCEN within 25 calendar days after the day of the transaction. So that's the rule that's been this way for a while, within 25 calendar days from the date of the transaction. I would be remiss if I didn't mention that that time period is going to shrink. In 2013, you will find that the CTR, so not currently but coming up soon, effective as of March 31st, 2013, the CTR must be filed within 15 days following the day in which there was a reportable transaction. So this is the way the rule's been for a long time. It's going to change soon, changing to be less, to be 15 calendar days. So that brings up a good point. The way the test is written is it says on the outline, we write the test to include currently applicable rules and regulations. So it's my job to teach you the currently applicable rules and regulations. So there's a current year contribution limit that will describe everything you need to know for this current year. This is a change that is coming up soon. So I'm not sure if you're taking the test before the change or after the change. So this is one I'm going to put into the course. I don't normally do that, but I can't help myself. Broker-dealers who transfer funds, including wire transfers of $3,000 or more, must collect, retain, and record certain information regarding the transaction, including the name and address of the transmitter and the recipient, plus the recipient's financial institution, account number, and amount of the transfer. Firms are also required to verify the identity of any transmitter or recipient who is not an established customer. So they could ask you the reporting of wire transfers of what amount is required, $3,000 or more. The USA Patriot Act also requires broker-dealer firms must establish and implement policies and procedures that can be reasonably expected to detect and cause reporting of what we consider to be suspicious transactions. So we've got the CTR, we said wire transfers must be reported, wire transfers of $3,000 or more. And now we've got what are called SARs, Suspicious Activity Reports. Suspicious activity reports are filed with FinCEN on commercial behavior which is commercially illogical and serves no apparent purpose, including but not limited to the following: opening up accounts for new clients who seem uninterested in products that may offer better returns, are unconcerned about suitability, have no clear investment objectives, have no concern about the amount of commission charged, conduct multiple transactions for less than $10,000 because they know if they get to that daily aggregate amount of over $10,000, then they're going to have the currency transaction report. So that is suspicious. Make unusual wire transfers to foreign countries or supply inadequate or false information. So if they give you a phone number that you can't reach them on, that would require the filing of a suspicious activity report. The suspicious activity report must be filed no later than 30 calendar days from the date of the initial detection of the suspicious activity, if I can talk. So filed with FinCEN within 30 days. And these are calendar days, unless no suspect can be identified, in which case the time period for filing an SAR is extended to 60 days. Both currency transaction reports and suspicious activity reports are filed with FinCEN. Today, all reports must be filed electronically. FINRA Rule 3310 is the Anti-Money Laundering Compliance Program rule. Each member firm shall develop and implement a written anti-money laundering program designed to achieve and monitor the members' compliance with the requirements of the Bank Secrecy Act and the implementing regulations promulgated thereunder by the Department of Treasury. So that includes the USA Patriot Act. Each firm's anti-money laundering program must be approved in writing by a member of senior management and shall, at minimum, establish and implement policies and procedures that can be reasonably expected to detect and cause the reporting of transactions as required under law, establish and implement policies, procedures, and internal controls reasonably designed to achieve compliance with the Bank Secrecy Act, provide for an annual, on a calendar year basis, independent testing for compliance to be conducted by member firm personnel or by a qualified outside party. The anti-money laundering program shall designate and identify to FINRA by name, title, mailing address, email address, telephone number, and fax number an individual or individuals responsible for implementing and monitoring the day-to-day operations and internal controls of the program. Such person must be an associated person of the member and provide prompt notification to FINRA regarding any change in such designation. And the firm must have procedures to provide ongoing training related to the firm's anti-money laundering program for appropriate personnel. The rule permits a member firm that does not execute transactions for customers or otherwise hold customers' accounts or act as an introducing broker with respect to customers' accounts to conduct its independent tests every 2 years. On a calendar year basis. All members should undertake more frequent testing if required by the circumstances. Independent testing must be conducted by a designated person with a working knowledge of applicable requirements under the Bank Secrecy Act and any implementing regulations. Independent testing may not be conducted by a person who performs the functions being tested, or by the designated anti-money laundering compliance person. That'd be really easy to sign off on your own program, or a person who reports to a person described as being either of those. Each member must identify, review, and if necessary, update the information regarding its anti-money laundering program compliance person promptly, but in no event no later than within 17 business days after the end of each calendar quarter to ensure the information's accuracy. So if the person changed, you tell them promptly, right away. But on a quarterly basis, within 17 business days, ooh, that kind of sounds like the focus filing rule. It is. You must tell them who is the anti-money laundering compliance person. The Securities Investor Protection Act and the Securities Investor Protection Corporation. SIPC. Years ago, I was driving out in, eastern Colorado, the border out there by Nebraska, in the middle of nowhere, basically, listening to some country radio station. And this little girl's voice comes on the radio, and it goes something like this. Securities Investor Protection Corporation protects you if your broker-dealer goes broke. Have you ever in your whole life heard an ad for the Securities Investor Protection Corporation? I have one ad. Little girl. There must have been a broker-dealer out there somewhere. I thought, well, that's really weird. So you need to know who they are, what they do, how it works if a broker-dealer goes broke. So SIPC is a non-profit membership organization designed to protect the money and securities of customers held by insolvent broker-dealer firms. SIPC does not cover bad investments. If you put all your money into Enron and then they went broke, it does not cover that. Members pay assessments into a reserve fund that is used to meet customer claims in the event of a broker-dealer bankruptcy involving missing cash and/or securities. SIPC supervises the liquidation of the insolvent firm and pays client claims. Members include virtually all registered broker-dealer firms. Although broker-dealers whose business is confined exclusively to the sale of open-end mutual funds, unit investment trusts, and the variable contracts of insurance companies are exempt from SIPC membership, since by law, customers' monies are held elsewhere. They're not held by those broker-dealers. So if all the broker-dealer does is engages in mutual fund sales, they do not have to be a member of SIPC. The Investment Company Act of 1940 requires that all mutual fund assets be held by an independent custodian. No broker-dealer selling mutual funds really ever has custody of their clients' money or securities. Thus, SIPC coverage is not needed. It is important to note, SIPC does not cover commodities futures contracts. SIPC does not cover fixed annuities. They're not securities at all. It does not cover limited partnership units sold as exempt securities. Firms that are members of SIPC must include member SIPC on all of their advertisements. You've seen that. Your firm does that generally. If they need to, they do, of course. The official SIPC logo must be continuously displayed at a prominent location at the member firm's principal place of doing business and at each branch office. Under SIPC, each separate customer of a broker-dealer is covered for a maximum, you definitely have to know this, maximum per separate customer, $500,000, of which up to $250,000 can be in cash. So $500,000 per separate customer, of which $250,000 may be in cash. Customers with claims beyond $500,000 are treated as general creditors of the firm at the bankruptcy proceeding. Securities are valued as of the date that the firm filed for bankruptcy with the court. So that's important. Securities are valued as of the date that the firm filed bankruptcy with the court. It's also important to remember that unlike the FDIC coverage, SIPC coverage is not blanket insurance coverage. SIPC aids most customers of failed brokerage firms who are owed cash and securities missing from customer accounts. Customers of a failed brokerage firm get back all securities, such as stocks and bonds, that are already registered in their name or are in the process of being registered. After that, the firm's remaining customer assets are then divided on a pro rata basis, with funds shared in proportion to the size of claims. If sufficient funds are not available in the firm's customers' accounts to satisfy claims within these limits, the reserve funds of SIPC are used to supplement the distribution up to a maximum of $500,000 per customer, which includes up to $250,000 cash per separate customer. So it's not $500 plus $250, it's $500,000 including $250 in cash. Additional funds may be available to satisfy the remainder of customer claims after the cost of liquidating the brokerage firm is taken into account. In a failed brokerage firm with accurate records, the court-appointed trustee and SIPC may arrange to have some or all customer accounts transferred to another brokerage firm. Customers whose accounts are transferred are notified promptly and then have the option of staying at the new firm or moving to another brokerage of their choosing. When SIPC asks a court to put a troubled brokerage firm in liquidation, the financial worth of a customer's account is calculated as of the filing date. We said that already. Filing date. Wherever possible, the actual stocks and other certificates owned by a customer are returned to them. To accomplish this, SIPC's reserve funds will be used, if necessary, to purchase replacement securities, such as stocks, in the open market. It is always possible that market changes or fraud at the failed brokerage firm or elsewhere will result in the returned securities having lost some or even all of their value. In other cases, the securities may have increased in value. Broker-dealers whose principal business in the determination of SIPC, taking into account business of affiliated entities, is conducted outside the United States and its territories and possessions, are excluded from membership in SIPC. These broker-dealers that are excluded because their primary business is done outside of the U.S. are required to make disclosures of this exclusion and other relevant information to the customers of such broker or dealer who are living in the United States or its territories and possessions. So if the major amount of business the firm does is outside of the U.S., it's possible SIPC will say, you don't have to join. And if the firm doesn't join and then the firm goes broke, U.S. customers of the firm that wasn't a member of SIPC are not covered by SIPC. So all of that must be disclosed. Regulation S-P is a financial services industry adoption of the Gramm-Leach-Bliley Act. It has to do with customers' information and privacy. So Regulation S-P, privacy. So the financial industry's adoption of the Gramm-Leach-Bliley Act. Broker-dealer firms must implement procedures to protect the privacy of customer records and information by prohibiting the sharing of non-public personal information about a customer to non-affiliated third parties, unless the firm provides certain information to the customer and the customer has not elected to opt out of sharing, as permitted by federal law, which permits a customer to send a written request that their personal information not be disclosed. Okay, what is all this? So there's certain things about a person you can never share with someone else. You can't share their social or their birthday. But it is sometimes true that a broker-dealer will think there's another non-affiliated business that might be interesting for the customers. So can they share that information? Yes, if they gave the customer the ability to opt out of this sharing and the customer did not elect to opt out. Then non-personal information, your name, your address, your email, then that sort of information can be shared. Regulation S-P requires that broker-dealer firms deliver an initial privacy notice to new customers no later than when the customer relationship is established, as well as annually to all customers. So initially, at the time the account is first opened, and thereafter every year, annually. So I remember when this rule first took effect, they all were sending paper privacy notices, privacy notices. It is true though, the firm's annual privacy notice may be delivered on its website if it is conspicuously displayed and the customer agrees in writing to receive it electronically. So that would be okay today. So Regulation S-P, privacy of customers, non-public information. Don't forget, you've got key facts. I know it's a lot of stuff to keep track of. So read the key facts, then take the quiz that follows after. If you don't know the answer, read the rationale. If you still don't understand, send me an email. This is a lot of stuff to get through, but I know you can do it. Good luck.